What is payroll? What does it mean to do payroll? What are all the ideas behind it? And what's going on with all these numbers that are on your check stub when you just got paid from your job? Well, in this video, we're going to learn all the important concepts and ideas about what payroll really is. Payroll is a legally required procedure that employers must perform when they pay their workers the workers' earned pay. Now, payroll requires physical record keeping and specific record keeping techniques that the law requires that you perform at the moment you go to pay your workers their gross pay. But then the question is, what is gross pay? Well, the gross pay is the main number in payroll that all the math calculations are based on once you determine how much it is. You see, gross pay is the amount the worker actually earned. You see, during the payroll process, money is both added to and taken from gross pay. From the point of view of the worker, money is taken from gross pay. But from the point of view of the company that's paying the worker, money is added to gross pay. Now, what am I talking about? You see, when the company pays the worker, the company is required to pay additional money to the government in the form of something called a payroll tax. Now, you may well ask, what is a payroll tax? Well, a payroll tax is a tax on how much the company pays the worker, just like a sales tax would be the amount of tax you would pay from the amount that you would purchase in a sale. So, for example, if you wanted to purchase some item that cost $100 and the sales tax was $8, you would wind up paying $108. It's the same idea when the boss pays the worker. If the worker earned $100 and the payroll tax, for example, was $8, the boss would wind up paying $108 for every $100 that the worker earned. So it works just like a sales tax, but it's based on the amount an employer pays an employee. Now, in this example, of course, the worker will not receive $108 because they've earned $100. Clearly, the $100 gross pay goes to the worker, and the $8 in tax goes to the government as a result of a company paying their employees. That's the same like a sales tax, where the sales price gets kept by the merchant and the extra sales tax goes to the government. Now, that doesn't seem too complicated because we all pay sales tax and we can understand the idea. But why are there so many numbers and so many calculations? Well, that's because, unfortunately, there are several payroll taxes that the company has to pay at the moment one worker receives one check for gross pay that they earn. And to make it worse, each of the different payroll taxes gets paid to a different department of government. And to make it even more complicated, each of the different payroll taxes needs to be sent in at different times to different places. So that explains the money that's added to the check that the boss has to pay over and above the gross pay. But now we'll talk about the worker's point of view and the taxes that relate to the workers. You see, the workers do not get their total gross pay in their hand. In addition to the company being required to pay extra tax on top of the gross pay, the company is also required to withhold some money from the worker's gross pay and give the worker the difference. And that amount of money that the company withholds is called withholding tax. So, at the moment the boss pays the worker the gross pay, the boss deducts the withholding tax, and the name of the money amount that the worker physically receives in their check is called the net pay. And you may well ask, what is this withholding tax? Well, we all know that everyone who earns money has to pay income taxes on the money they earn. And unfortunately, the law requires that every worker, every employee, anyone getting a check for money they earned is required to pay their share of taxes from that very paycheck, from the gross pay, and they're required to pay it at the moment they get the check. That's the legal requirement on the worker, the employee. But the law also says that the employer, the company paying the money, is required to help them with this. Now, how do they help them? Well, if I'm a worker who earned $100, I am legally required to send in a percent of that as my income tax. So let's imagine that's $30 out of the 100. But the law does not say when I get the 100, I have to send in the $30 to the government. The law says the boss has to do it. The company that's paying me $100 is required to withhold my share of my federal income tax and send it into the government in my name, the name of the worker. That's what the law requires. So, at the moment you get your check, you actually paid your taxes by way of the company holding on to it and sending it in your name. So that leads to a great deal of complicated record keeping. And to make matters worse, there are actually several withholding taxes that the company is required to withhold at the moment they give the worker their gross pay. So each of these different withholding taxes, again, gets sent to a different department of government, and they get sent in at different times. So think about the requirement on the company at the moment one worker gets paid one check. At that moment, the company legally owes several different payroll taxes to several different departments of government. And because the company withheld all of the different withholding taxes, the company also owes withholding tax from the worker to several different departments of government that each get sent in at a different time. Whew. We're talking about a massive amount of record keeping at the moment one worker gets paid one paycheck. So exactly how is this done in the company records when they go to pay their workers? Well, firstly, the company needs an expense type of account in their chart of accounts to record the gross pay, which is the amount the workers actually earned. That means it's the amount the company actually incurred as an expense. So you have to have one expense account that represents the gross pay. Sometimes it's called salary expense if the workers get paid a salary. Sometimes it's called wages expense if the workers get paid hourly instead. But you must have this expense account in the chart of accounts to record the actual amount earned by the worker at the moment the company pays. And then, of course, the company must have an additional expense account in the chart of accounts to record the payroll tax that they owe and must send in to the government at the moment they pay the worker. In fact, there are actually two accounts that relate to the payroll tax. There's the expense account, which actually shows the amount of expense the company incurred or acquired when they paid their worker. But of course, the payroll tax does not get paid to the government at the exact moment the worker gets paid. So therefore, the company needs a second account in the chart of accounts just to record what's owed to the government in payroll tax at the moment the company pays the worker. So that's 3 accounts so far: gross pay salary expense, payroll tax expense, and payroll tax liability, which is the account that shows the balance owed to the government in all the payroll taxes that the company accumulated for all the pay that they paid the worker. And regarding the withholding tax, of course, the company owes the money to the government at the moment the company gives the worker the check and withholds the tax. But also, of course, they're not going to send in the tax at the moment they pay the worker. These different withholding taxes get sent in at different times. So the company must keep records of how much is owed to the government at any given moment for each of the workers' withholding tax. Therefore, if the money is owed, that withholding tax gets recorded in a liability account. So there are several liability accounts involved in paying workers. There are the liability accounts that indicate what's owed in payroll tax, and the liability accounts that indicates what's owed in withholding tax. And of course, because this money is expected to be paid reasonably soon, these liability accounts are classified as current liabilities. And that's only the record keeping in the general ledger. But in addition to the general ledger, you need 2 additional areas of data in your QuickBooks Online to manage the additional information over and above the transactions that get recorded in the general ledger. The company is required to keep track of each of the different liability balances that are owed to each of the different departments of government for both every payroll tax that's owed on one worker's check and every withholding tax that's owed at the moment the boss pays the worker the check. And in addition to that, each employee that is paid a check must have a separate record inside the QuickBooks Online software to keep track of every paycheck, every amount of gross pay, and every amount of withholding from every paycheck that they ever received. This information is necessary because, as we all know, the company needs to use each individual employee earnings record to create a W-2 at the end of the year. And we all know, as employees, we get a W-2 that tells us all of our gross pay and all of our withholdings, and that W-2 helps the worker file their final income tax the following year. So to make it clear exactly how it works, let's imagine that we are not using the payroll feature in QuickBooks Online, and we're recording things the old-fashioned way. And in this very simple example, to give you the whole idea, we're only going to pay one worker one paycheck. So let's imagine in this example, the worker earned $100. And let's imagine the payroll tax is 5%. And in this example, we'll start off with owing only one payroll tax just to keep things simple. Let's also imagine that their withholding tax is 10%. And again, for this first simple example, let's just imagine there's only one withholding tax. So again, the worker earned $100 and there's $5 in payroll tax that the company pays extra, and the company must withhold $10 from the worker's check. In this example, exactly how would that be recorded in the days before the computer? So at the moment we pay one worker one check where the gross pay is $100 and it's the days before the computer, we would record this in the general journal. First, we would have to record the gross pay as salary expense, and that would be recorded in the debit column for $100. Then we'd have to record the payroll tax as payroll tax expense, and that amount would be recorded in this example as $5. But wait a minute, the company did not send in the payroll tax at the moment they paid the worker. They just owe it at the moment they paid the worker. So in addition to a debit of payroll tax expense for $5, we also have to record a credit of $5 in the account called payroll tax liability. So $5 goes into the expense account to show what we incurred, and $5 goes into the payroll tax liability account to show that we owe the money to the government at the moment we paid the worker. Now, what about the withholding tax? Well, of course, that's a liability. And if it's $10, we would then make a credit of $10 to the withholding liability account that represents what we owe the government for the amount that we withheld from the worker's check. So what would be the only remaining account in the chart of accounts that we would have to record this paycheck in? Well, if we're actually paying the workers, that means our cash in bank is going to decrease. And it's going to decrease by the amount of the net pay, the amount we actually pay the workers. And in this example, if they earned $100 and we withheld $10, that means the amount of net pay that actually decreases the cash in bank would be $90. And if you record that $90 on the credit side, because that's where it belongs, you will see that that amount balances out the journal entry and the debits equal the credits for this particular paycheck. And now you can see how difficult it was and how much record keeping there was regarding keeping payroll in the days before the computer. But if all that still wasn't enough for you, guess what? There's one more additional responsibility that goes along with managing payroll. Every department of government that you are required to send the payroll money into also requires that you fill out and send in payroll tax forms. Yes, that's right. These are specific forms that each department of government requires that you fill out and send in periodically. Sometimes you have to send in the forms when you send in the payroll money and the payroll taxes. But sometimes you have to send in the forms after a specific period of time, whether the payroll taxes are due or not. And all of the information that you write on the forms comes directly from the summary information from your payroll records. So you can see that adding this additional responsibility regarding filling out and filing forms, in addition to everything else that the law requires, basically makes doing payroll a full-time job. If you're not using the computer or a really great program like QuickBooks Online. And that's why many companies, possibly most companies, do something called outsourcing their payroll. And outsourcing payroll means you pay a separate independent company to do all the responsibilities that your company is legally required to do every time you pay your workers the weekly payroll. If you sign up with an outside payroll company, they will do everything for you. All you have to do is give them access to one of your bank accounts where you make sure there's enough money in there to pay the workers and the taxes, and they will do all the work and keep all the records and send in all the forms. They are the ones responsible for printing your workers' checks, putting them in an envelope with the stub, and making sure you have a stack of paychecks that are accurate that you can hand to each worker every pay period. They are the ones that keep continuous records of the employee's earnings and all of the employee's withholdings, because they are the ones responsible for issuing the W-2 at the end of the year. They are the ones who take the responsibility of making sure that every payroll tax is paid in the correct amount, to the correct place, at the correct time. And they are the ones who take responsibility in making sure that all of the numbers on all of the payroll tax forms that you are required to send in are accurate and get sent in to the correct places at the correct times with the right numbers. So this takes the burden off of you and your company, and it usually works out to be cheaper than paying an in-house bookkeeper full-time, extra hours, just to keep the payroll in-house. But some companies still keep the payroll in-house because they want their payroll to be confidential and they don't want an outside payroll company knowing their payroll information. So these are the choices that you have when you have workers that you are legally required to initiate the payroll procedures for. And if you choose to use an outside payroll company, all you have to do every pay period is give the outside payroll company all of the workers' work hours, and they will do all the work and give you one big fat statement. And this statement explains everything they did during the pay period. And all you have to do is take that statement, open up the general journal, and make one big fat journal entry that records everything on the statement that you got from the outside payroll company. They make it that easy. And if you're curious exactly how to record that big fat journal entry from an outside payroll company, then you have to watch our next coming video. I thank you for your time, but at least in this video we all learned exactly what payroll is all about.